A stock triples in a year. Then Wall Street analysts line up and call it cheap. Not reasonably priced, not fairly valued given the growth. Cheap. As in, a forward price-to-earnings ratio under 8. The kind of number you'd expect on a struggling industrial company or a bank no one trusts, not on one of the fastest-growing businesses in the semiconductor industry. That's where Micron technology sits right now. And either something is deeply wrong with the thesis, a growth story that's about to unravel, or the market is pricing this company using a set of assumptions that no longer apply to what it's become. Earnings are expected to grow more than 500% this fiscal year. Not 50, not 100, 500. The production line is sold out through the end of 2026 under long-term contracts. Margins just hit record highs. So which is it? Is this the kind of stock that doubles again from here, or the kind that reminds investors why spectacular numbers are sometimes a warning, not an invitation? That's what we're going to work through. Most people, when they hear memory chips, picture a commodity, something fungible, something where the cheapest producer wins and everyone else struggles to stay alive. For most of Micron's history, that read was essentially correct. It isn't anymore. And the reason is a product most investors still underestimate. Micron makes three main things. DRAM, the fast, active memory your laptop uses while it's running. NAND, storage memory, the kind inside solid-state drives. And then there's HBM, high bandwidth memory. This is the one that changes the analysis. HBM is what sits directly alongside the processors that run AI models. Not next to them in a rack somewhere, physically adjacent, stacked on the same package. It exists because AI workloads move data at a scale that conventional memory architecture cannot handle without becoming a bottleneck. Training a large language model, running inference at scale, processing the kinds of data volumes that modern AI infrastructure requires, none of that works efficiently without HBM feeding the processor fast enough. Here's the number that matters. Micron is one of 3 companies in the world that can manufacture HBM at the level of sophistication current AI systems require. 3. Samsung, SK Hynix, and Micron. That's the entire market. There is no fourth option waiting in the wings. This isn't a company selling memory into a crowded market anymore. It's a company sitting at a structural choke point in the global AI buildout. That distinction is what makes the financial results look the way they do. Micron just reported its fiscal second quarter results, the period ending February 2026. Revenue came in at $23.86 billion. That is almost 3 times what the company produced in the same quarter a year earlier. Not 30% growth, not 50, nearly triple. Adjusted earnings per share hit $12.20. Well above what analysts were expecting. Gross margins reached roughly 70%. Let that land for a second. 70% gross margins in a business that spent most of its history treated like a commodity. A business where, in bad years, Micron sold chips below the cost of making them. Margins like that don't just mean the company is doing well. They mean something has changed about the pricing environment itself. Then there's the guidance. Next quarter, revenue around $33.5 billion. Adjusted EPS near $19.15. For the full fiscal year ending this August, analysts are now projecting revenue above $108 billion and earnings per share around $58. From the prior year, more than 500% earnings growth. The balance sheet is healthy. Cash flow is strong. The company raised its quarterly dividend, which is management's way of saying, publicly and on the record, that they believe this isn't temporary. Here's a question worth sitting with. When was the last time you saw a large-cap company project 500% earnings growth and have it treated as credible by serious analysts, rather than greeted with skepticism? That alone tells you something is unusual here. The question is whether the unusual thing is real or whether it expires. The honest objection to all of this is obvious, and it should be taken seriously. The memory chip business is cyclical. It always has been. Prices rise, producers get confident, capacity gets added, prices collapse, companies report losses, capacity comes out, and the cycle starts again. Micron has been through this multiple times. Investors who bought at the top of previous cycles got hurt badly. So the real question isn't whether Micron's numbers are impressive. They are. The question is whether this is a cyclical peak, the kind that historically precedes a painful correction, or something structurally different. The case for structurally different comes down to the nature of the demand driving the current environment. AI infrastructure spending doesn't look like the PC boom or the smartphone upgrade cycle. Both of those were primarily about unit volumes, how many devices people bought and how often they replaced them. AI infrastructure is about the intensity of compute per application. A single AI training cluster requires several times more memory than an equivalent cost conventional server farm. That demand is additive. It sits on top of existing memory markets, not instead of them. And HBM specifically has a feature that past memory booms lacked: contracted supply. Micron's HBM production for all of 2026 is already sold out under firm contracts with major customers. These aren't purchase orders that can be walked back easily. They're commitments. That's not speculative demand priced into a stock. That's revenue that is essentially locked. Supply can't respond fast enough to relieve the pressure because HBM manufacturing is technically difficult. New capacity takes years to build and qualify. Micron is spending over $25 billion this year on capital expenditure to expand. And even at that pace, meaningful new supply doesn't arrive until 2027 at the earliest. So consider the scenario directly. What would have to happen for this to be just another cycle peak? AI spending by hyperscalers would have to decelerate sharply and faster than the current rate of new chip production. That's possible, but it would require a reversal of capital allocation decisions that Microsoft, Google, Amazon, and Meta have all made publicly, with hundreds of billions of dollars in committed spend behind them. That's a different risk than the memory market turned. Think about where you stand on AI infrastructure spending, whether this is a multi-year structural commitment or a wave that breaks in the next 18 months. Your answer to that question is really your answer to whether Micron's current position is durable. At roughly $423 per share, the stock's forward price-to-earnings ratio on fiscal 2026 estimates is around 7.6. That number deserves attention, not because it's low in absolute terms, but because of what it implies about market expectations. A PE of 7.6 on a company growing earnings at 500% annually means the market is essentially pricing in mean reversion. It's saying, we don't trust these earnings to persist, so we're discounting them heavily. That can be a rational position. Memory cycles do mean revert, and the market has learned to be skeptical. But it can also be a position that lags behind reality when the structural conditions have genuinely changed. The PEG ratio, which compares valuation to growth rate, sits around 0.26. The conventional threshold for undervalued relative to growth is 1.0. Micron at 0.26 is priced closer to a mature, low-growth industrial than to a company that just tripled revenue in a year. There are legitimate counterweights. Price-to-book and price-to-sales ratios are elevated by historical standards. The stock has already run more than 300% from its recent lows. These aren't irrelevant data points. Investors who bought at the top of a cycle and watched metrics normalize know why they matter. But here's the thing. If the earnings trajectory holds into 2027, today's price starts looking conservative against those numbers too. The forward-looking valuation doesn't just work at 1 year out. It compounds. Ask yourself this directly. Would you pay 7.6 times earnings for any other business growing at this rate, with contracted revenue and 70% margins? If the answer is yes, the only remaining question is whether you trust the earnings to hold. 3 risks are real and worth naming without softening. The first is cyclicality. Micron is spending $25 billion or more this year on new equipment and factories. That's a fixed commitment in a business where demand visibility beyond 18 months is limited, even with contracts. If AI infrastructure spending decelerates, whether because of an economic downturn, a shift in model architecture that reduces memory intensity, or simply a pause as the largest buyers digest what they've already built, pricing could soften faster than most models assume. Capital-intensive businesses with high fixed costs don't handle demand shortfalls gracefully. The second is geopolitics. Micron has factories in Taiwan and a meaningful customer base in China. US-China trade tensions already forced the company to restructure its China business once. A re-escalation, new export restrictions, retaliatory tariffs, restrictions on selling to specific customers could affect both production geography and market access simultaneously. This isn't theoretical. It's happened before. The third is competition. Samsung and SK Hynix are not watching from a distance. Both are investing heavily in next-generation HBM. Micron's current technology position in the HBM market is real, but leads in semiconductor technology don't last forever. The gap that exists today could narrow in the next product cycle. Here's the distinction that matters for how to hold the position. Some of these risks break the thesis, and some create volatility without breaking it. Geopolitics and competition are thesis risks. If they materialize in a serious way, the structural argument changes. Cyclicality and short-term price swings are not thesis risks. They're the cost of owning a semiconductor stock. The stock can move 20% in a month in either direction. Investors who can't hold through that should size the position to reflect what they can actually stomach, not what the thesis says it's worth. Micron has spent most of its existence being treated like a commodity business. For most of its existence, that was correct. The HBM market and the AI infrastructure wave behind it has changed what the company makes and who needs it at a level that the forward valuation doesn't yet reflect. That gap between how the market is pricing the company and what the company is actually producing is the investment case, stated plainly. A 3 to 5 year horizon, modest position sizing relative to the volatility, and attention to quarterly results for any softening in HBM demand or contracted pricing. That's the framework for owning it. One final note. Everything here is for thinking, not for acting on without your own work behind it. This is not financial advice, and I'm not your advisor. The research, the judgment about your own risk tolerance, and the decision, those are yours.